Good morning, everyone. This is John Kogan. I'm the CEO of Performative, the online community for corporate finance, accounting, treasury, and related professionals. First, I'd like to welcome everyone to today's webinar, The Ripple Effect, Convergence of Financial Instruments, Leasing, and Revenue Recognition for IFRS and US GAAP. The FASB and the Iasb are moving closer in convergence on financial instruments, RevRec, and leasing accounting standards. Applying the new standards will cause several ripple effects, from changing processes used to orchestrate financial reporting, as well as changing balance sheets and income statements. In this webinar, we will cover the potential impact that the proposed changes will have in these key areas on topics such as accounting, processes, and systems. Today, we hope that you'll learn many of the key ins and outs on these topics, and how they might affect your business, and how you might best prepare for and address them. We have an amazing panel of experts this morning who will be sharing their knowledge on this next wave of standards, and we welcome everyone, and we thank you for your valuable time this morning. We'll go through a few slides of housekeeping items before we get to the content. The first is, of course, welcome to Performative. To those of you for whom this is your first Performative event, we're happy to have you on board. Performative is a large online resource for senior finance, accounting, treasury, and related professionals, and all we do is ask questions and give answers to one another. We have over 500,000 CFOs, controllers, treasurers, and related folks. And it's a wonderful resource. It's all completely free and noise-free. And speaking of free, a great thanks to our sponsor this morning, SAP, for allowing us to deliver this event at no cost to all of the attendees. Check us out at performative.com if you have not done so before. A few notes on today's event. A link to today's presentation will be sent out to all attendees within 24 hours. And in fact, today's presentation is already posted on Performative and freely available. If you'd like to get the slides and follow along, please feel free to do that. You can go to performative.com/resources, and it will be right there at the top of the page. We are offering CPE credits for today's event. That means, amongst other things, that we will be asking 2 polling questions today. Now, the questions are actually broad-based, and they're not a test. It's more about getting some statistical information from folks, and maybe having a few things that we can revisit when we get to the Q&A. So if you're here for CPE credit, you must take the polls. But even if you're not here for CPE credit, please do consider taking the polls. It's very quick and simple, and we'd love to see how companies are thinking about and preparing for these convergence issues. So that's what the polling questions will cover. You will note that there is a section on your GoToWebinar control panel entitled Questions. Please feel free to ask questions at any time during today's event, and we will do our best to get to them during the Q&A portion of the webinar, which will be the last 15 minutes of today's event. So ask questions at any time. And finally, when you depart today's webinar, you will be asked to take a short survey, literally about 60 seconds. We greatly appreciate your feedback on today's event. And also, we make it very simple. If you would like us to help connect you with any of today's speakers, and certainly we've got an amazing group of speakers today, then we'd be happy to help make those connections. So that will be on the survey as well, and you can just click your mouse, and we'll help connect you with whomever you'd like to speak to. We've got a lot of things we want to cover today. The main topics, of course, are convergence issues around revenue recognition, lease accounting, and financial instruments. And we're going to be covering a lot of territory, so this is a bit of a survey course this morning. But we're happy to have you with us here today, and I'm very confident that you'll come out of this hour knowing a lot more and hopefully being much better prepared personally and for your company to be ready to address all of these issues. Okay, so at this point, let's go ahead and jump right in. And to do that, I'd like to start by introducing our first speaker. His name is Pete Graham. He's a Director of Financial Solutions and Mobility at SAP Labs. Pete currently leads the global activities on IFRS, accounting change, and mobility for finance solutions at SAP. He helps customers understand the latest information about SAP solutions and how those solutions can make their companies run better. He has 15 years of experience in the enterprise software industry in a variety of product and operational roles. I would also like to introduce Tom Anderson, Principal Consultant at SAP. Tom is Principal Consultant for SAP in their North American real estate practice. He works closely with SAP development and has been involved with the development of SAP's FAS 13 solution, Common Area Maintenance Recoveries, and currently the IFRS solution for non-movable assets. He has 14 years of experience in the enterprise software industry, primarily in delivery of solutions. He is also a frequent speaker and presenter on real estate topics. And with that, Brian, feel free to take it away.
Okay, thanks, John.
I'm sorry, Pete. Feel free to take it away.
Thanks, John. So as John mentioned, we have a great set of panelists here. So first I want to thank the panelists for carving time out of their busy schedule. They do this in 24/7, and so it's going to be great to get their insights here. What we've scheduled or have organized is just a quick overview of the key topics on IFRS Convergence right now: financial instruments, leasing, and revenue recognition. And what I'm going to do is really create or go through a broad brush and really, kind of from a layman's perspective, just paint this very broad brush, and then we'll have a detailed discussion here shortly where our experts on the accounting side can really come in and give their insights. So we're going to start with financial instruments, and certainly the background on this is that, and this is primarily related to financial services, and there also is some hedge accounting, but essentially this is a project that was started in 2008. It's now been broken up into 3 phases. There's a classification and measurement, there's an impairment of financial assets, and there's also hedge accounting. And the objective is to improve the usefulness of the financial instrument or financial statements for users by simplifying the classification and measurement requiring for financial instruments. And the current status of the project is this project actually has been, or these 3 phases have been going forward fairly well. They seem like they're all on track. We've got some exposure drafts coming up in phase 2 and 3, but the effective dates are all on track at this point for January 1st, 2015. In general, you know, as I look across these topics, the one that we're getting the most interest on or conversation about is leasing. Rev Rec is next, and financial instruments is farther behind, and I think it's just because in general it seems to be working more smoothly. From a layman's perspective, what do you need to know? On classification and measurement, the classification is going to be according to the cash flow characteristics of the instrument and the entity's business model. So there might be changes related to the current classification of financial assets. More instruments are likely to be measured at fair value. There are 3 categories left in terms of amortizing the cost, fair value, OCI, and fair value P&L. And there's also a way to bifurcate financial liabilities but not allow for financial assets. There's also impairment of financial assets at amortized cost, and this is going to be moving from the incurred loss approach to expected loss approach. Essentially, this may allow losses to be recognized earlier. For all assets, if recognition of the expected loss is within the next 12 months. There also could be a deterioration in credit quality leads, and that would lead to a recognition of full lifetime expected loss. The other area is around hedge accounting. And again, this is a general model. The macro hedge accounting will not be part of IFRS 9. Certainly there is going to be, they're trying to get stronger alignment with the actual risk management kind of versus the principle-based approach in hedge accounting. So that's kind of a very high-level financial instrument. So let some of the experts kind of comment on this in a second. But let's now move to the next topic. Sorry, a little latency on lease accounting. And lease accounting, again, is probably our top request at the moment from our customers. And this project goes back to 2006. There's been a lot of comments on this in the back. I guess the famous quote is that you know, you can't really jump on an airplane around the world if and it turns out that airplane is not on the balance sheet of any company because of all these operating leases. So long story short, the objective of the project was to eliminate the different accounting for operating and capital leases and better reflect the impact of operating leases on the company's performance and really make sure that the recognition of the assets and liabilities related to those lease contracts are properly reflected. There's also the objective of providing the information in the financial statements about the amount, timing, and uncertainty of the cash flow from these lease contracts and just make it more transparent. We have had a lot of work on this in the last couple of years. There was an update recently a couple weeks ago, and right now the timing is that the re-exposure is likely to occur with a second exposure draft by the end of this year. There have been some fairly big changes to the proposals for lease accounting since the last exposure draft, but what we're now seeing is kind of a convergence in that the boards are really, in this last update, really seem to put a line in the sand that they have come to the major agreements and that they are going to get this resolved by the end of this year or next year, and that this, I think there's a feeling that this lease accounting standard now is actually going to happen, and the timeline is such that it might happen a little later. Maybe it goes out to a 2017 effective date, but that this will happen, and so we're seeing a lot of interest in it. And we'll talk about that with the panelists here in a minute. So certainly in terms of what you need to know for lease accounting, you definitely want to get your arms around your leases. This could be as easy as creating an inventory of the lease contract and making sure that you understand the basic terms and conditions. Certainly, for short-term leases, there are some exceptions, and there won't be major changes compared to the current regulations. The next two items we kind of split up into lessees and lessors. For lessees, all the leases will be recorded on the balance sheet according to the right of use approach. For lessors, the plan regulation will be like current operating lease if the lessee does not acquire more than an insignificant portion of the leased asset. And one of the comments I want to make in here is there's some language in here in the leasing that seems a little subjective, and I'm going to leave that to our experts to comment on, especially around this term insignificant portion of the leased asset. With that, we'll move on to the next topic, and again, this is a broad brush survey. We're going to we're going to have a deeper dive discussion here in a few minutes, and really let the experts here add their insights. On RevRec, again, this is a project similar to leasing, almost in the same time frame, that was started to really make sure that there was a common revenue recognition model, a single model across all these different industries. It turns out there are a lot of inconsistencies and weaknesses in the current approaches across the U.S. GAAP standards and IFRSs. So the boards are really trying to provide a single, more robust framework, allows better comparability, better disclosures. Hopefully it simplifies the prep of the financial statements, and it's more uniform across different entities. Now, it could be there are some other industries that aren't covered by this standard, such as insurance, but for the most part, this will be across all industries. Kind of the big strategy or logic of how the accounting mechanics work is that basically transfer of control is the new major metric or theme around when the revenue is recognized, and that's versus an older version of realized or realizable and earned. And there's a FASB footnote in here if you want to go and look into the details here. Essentially, there's a newly proposed 5-step approach in that when you're recognizing revenue, you're going to identify a contract, you identify the performance obligations. Perhaps this is different than what you're used to today. It could be the revenue in your contract does not match the revenue you're going to put in your books under the new regulation because there are performance obligations that will cause a deferral. You determine your transaction price, you allocate the transaction price to the performance obligations, and then you recognize the revenue according to the recipe. There is some other guidance for costs and disclosures, and I'll let at a high level, that's kind of what you need to understand. Certainly, when you look at your revenue contracts today, you're going to have to take a new look or a fresh look with some of these new standards and make sure that revenue is actually all recognizable. Certainly, some questions you need to ask yourself are, is my industry affected? Some industries are already using the newer recognition, revenue recognition policies already, and so it will not be a big shift, where other industries are not, and it will be a big shift. Certainly, you need to understand your contracts, how you may be bundling your revenue, or you're doing it over time, or discrete points. Maybe you're chunking it up. Talked about bundling, definitely performance obligations. You need to really understand the types of performance obligations you may have in your contract. Examples in our business are things like future discounts. Certainly, you need to make sure you understand how to allocate cost to performance obligations, as well as do you have the right data for disclosures, and that's actually one issue. There's a much higher level of disclosures now needed, and does your, do you have that data available, and do you have the right processes to capture that data and get it into the right financial statement? So with that, we're actually going to switch to the next section, and before we do that, I'm going to turn it over to John so he can give the first polling question.
Great. Thank you very much, Pete, for that quick overview. And we're going to go ahead and launch the first polling question. Once again, if you're here for CPE credit, you need to take this, but even if you're not, we'd like to know your answers to this question. We'll leave this open for just a minute here. In the meantime, I'll remind folks that you can ask questions at any time. Just go to the questions area in your GoToWebinar control panel, and we will do our best to get to those questions when we get to the panel Q&A, which is the last section of today's event. We'll go ahead and leave this open for another 5 seconds. Pop your vote in if you haven't gotten there yet, and we'll go ahead at this point and close that down. And Pete, I'm going to give control back to you at this point.
Okay, thanks. So I think at this point what we want to do is go through and allow our panelists to introduce themselves, and then we'll continue our discussion and actually take a deeper dive on the topics, financial instruments, rev rec, and leasing that we just went through. So why don't we start with Miles?
Thanks, Pete. Yeah, I'm Miles Corson. I'm the markets leader for Ernst & Young's Financial Accounting Advisory Services practice based in New York. As you can probably tell by my accent, my background is from Europe, so I specialize in advising on IFRS adoption and focus in the US, really advising some of our largest clients on the challenges around IFRS and Convergence.
This is Eric Moe. I'm a director with Deloitte & Touche based in San Francisco in our Financial Accounting and Reporting Services group, which is just a fancy way. I do many of the similar things that the rest of the panelists do in terms of focusing on IFRS and Convergence matters for our clients, helping them think through not only the technical aspects, but also kind of the operational impacts of adopting either a whole new body of standards or individual standards such as the new Lease or revenue recognition standards.
Great. And Rich?
Hi, Rich Sabula, Director with PwC in our advisory practice out of New York. I lead our SAP IFRS practice, which is basically my primary responsibilities are more around the process and technology impacts around SAP to support the IFRS's changeover and convergence for convergence topics. So basically complementing the accounting folks on the line with the processes and technology implications and changes.
Brian Heckler, our partner in charge of our accounting advisory for KPMG and responsible for our accounting change services around IFRS and others here in the U.S.
Great. Well, thanks again for our panelists for joining. So one thing I wanted to mention before digging into the subtopics here is that the U.S. SEC did publish on Friday, their staff did publish an updated work plan for IFRS. And so that is actually an interesting document, and we may have some comments from our panelists as we go through. It's a very large document, 137 pages. There are no policy decisions in that document, but there's a lot of information and a lot of very useful content is in terms of how companies potentially would adopt IFRS. So with that, what I wanted to throw a question out to the panelists is that, what additional info, and we can go through each of the topics at a high level, and then, or I should say in turn, and then I think we may end up spending a little bit more time on leasing just because that's a topic that we're just getting a lot of interest on. But what additional information should our attendees understand about, for instance, financial instruments, and potentially what should they do to prepare and are there any major risks around that area that they should be looking out for? And I'll throw this open to the panelists to see if I'm not sure if Miles or Brian would be able to take this one to start off.
Yeah, Pete, you had mentioned about the SEC staff report, and I was just kind of reflecting on that. It's telling if you look at this, Brian. If you look at that 137-page statement, a few things come to mind. I think its overall tone is a bit negative towards the adoption of IFRS. They cite that there's significant diversity in practice amongst their review of IFRS application worldwide, and there still seems to be the need for a more strong and timely interpretive body and better coordination amongst regulators, which really gets to that foundation premise of having a robust application and interpretation that's consistent worldwide. And I think one way you could read their report is that it needs more time to mature and to get more infrastructure established to where the application of IFRS is a little more consistent and commonly applied. So that's one thing that kind of suggests that there'll be more time before the U.S. is ready. And I think another observation that I saw was the cost element, that the cost to smaller companies, the cost to large companies around being able to adopt in any kind of a big way a quick conversion event. It just seems like there was a tone of concern about cost benefit and whether financial reporting really gets improved by going to an international standard base that's less consistent and maybe less transparent. But be curious what others saw. Those were the key takeaways I saw in that report.
Yeah, Brian, it's Miles. I agree with your comments. I think the SEC has clearly been through a very diligent process of working through the work plan, and this was really the report out on those various steps that they'd identified. Obviously, the commissioners need to review that, and I think to your point, that's going to take some time. So I wouldn't expect a decision anytime soon. The one thing I might just add is I think in terms of the mechanism, obviously this idea about endorsement and retaining the role of the FASB going forward as the sort of still the principal standard setter in the US clearly is something that the SEC has talked about previously, and I think it was covered at the AICPA conference by both Leslie Seidman and Hans Hugervorst, the chairman of the FASB and Iasb respectively. So I agree with your comments.
I mean, it does seem to put more focus and emphasis on the more near-term realities of the convergence projects, which are on the topic here today. Pete, in my mind, it kind of says, don't expect some, big broad brush kind of full-scale switch to a different book approach in the near term. I think it'll be a series of individual migrations closer and closer, and these individual FASB projects, I think, get more relevance and are much more important in the near term to be focused on.
Yeah, and Brian, again, the other thing I think I would also add to that is statutory reporting. For global organisations, there are markets around the world that for statutory reporting purposes are moving towards IFRS or IFRS-based standards. So I think for a lot of our multinational clients, what we're seeing is the need to still be thinking about IFRS and making sure they have a central purview on what elections and policies may be being adopted by local countries, local country management for IFRS reporting purposes.
Yeah, that would really be the nirvana, right? If you had the ability offshore to have one set of books around the world, that would make compliance so much easier for people. I do see some clients trying to aim towards that goal of, notwithstanding the lack of a decision or a permission to adopt IFRS here for domestic filers, that they're still exploring whether they can harmonize their offshore operations and get some efficiency and process gains by getting to a common platform. And IFRS may be the tool to get you there.
Yeah, and certainly where we're involved in large finance transformation initiatives, looking at application of shared services now, that is something we obviously talk to clients about. Is there an option to use IFRS that means you can pull more of the statutory reporting into a shared service environment and drive efficiencies that way?
Yeah. So Eric, we had a thread on this offline related to work plan. Did you have any other comments on this topic?
No, I think the only thing I would add is, the commenting on kind of the timing of when the SEC, might make a decision. If you think about where we are from a kind of a broader perspective, is that Jim Croker, the former SEC chief accountant, left his post the other week. The SEC just announced Paul Beswick will be the new SEC chief accountant, and Paul was heavily involved in kind of directing that work plan effort. So there's a little bit of kind of a changing of the guard there. Plus, think about from a broader political standpoint, we're heading into an election year, and so there's just some, some broader topics, that from a political standpoint that need to be resolved, as well as kind of the more kind of nuts and bolts of the kind of the nuances of actually moving to IFRS.
Okay. So getting back to the standards, I mean, which, as we look across financial instruments, leasing, and Rev Rec, I mean, what additional information would our panelists like to add or like to point our attendees to, that here are the items that they should really focus on or dig into or provide more insights or clarity on?
Peter, it's Miles. Maybe I'll just make some opening observations, because I think that the title of the webinar, the ripple effect, is actually pretty spot on in terms of, I think the need is to look at these things holistically, both in terms of the accounting consequence and the consequences across the organisation. I think obviously one of the challenges clients face right now is actually dealing with all of the uncertainty. So you've got uncertainty on some of the final scope of these standards and the timing, and how do you plan and prepare, to deal with those changes over an extended time period. And I suspect most of the companies on the call have other initiatives going on in terms of cost reduction, ERP implementations, a lot of other things happening. So I think one of the big challenges is how do you make sure you have appropriate resources identified and available in a suitably flexible way to deal with these issues as they get finalized over the next 12 to 18 months.
Yeah, I think one of the downsides that I'm seeing, Miles, is without a big bang kind of event, it's going to be harder and harder for controllers and IT directors to justify getting the funding and the resources to do the Chinese water torture of 4 or 5 pretty significant standards and all the implications that has, and working through the system, particularly if those are not all aligned to be adopted at the same time.
Yeah.
So I think generally finance staffs are pared down pretty thin right now, don't have a lot of extra time outside of the quarterly close and the year-end audit and their control responsibilities. Then to add on adoption of a lease standard or a revenue standard that are fairly comprehensive undertakings, I think are going to be really challenging to justify getting the resources required to take those things on. And that just puts more pressure on the workload of staff in many companies that we're seeing now.
Yeah.
So we've seen this, we had originally a couple of years ago, it seemed like it would be this big mass adoption or big bang approach, and then we had the famous condorsement, right, come out, and then so now it seems like we are getting closer to, and I think several of the panelists have already mentioned, these smaller projects, and that it's going to take a little longer. And so this is getting piecemealed up, it sounds like. That's kind of the direction we're going.
Yeah, it looks that way, right? And that's where I think, the challenge is for controllers and others to stay focused on the big picture when dealing with the small item in front of them. Because if you take these sequentially and you go and adopt for a revenue project, and then you come along and adopt for leasing, and then you deal with FI or consolidation, whatever, individually they sound disconnected, but to Miles' point, they're interrelated. And if you're putting it in the context of system requirements and process enhancements and maybe performance improvement, you might design things differently than if you looked at them in individual discrete projects.
Yeah. Yeah. And I think the other thing is, this is clearly not just an accounting exercise, and I think the broader engagement piece here is particularly important around lease accounting and revenue recognition, because where you're entering into major long-term leases, or if you're a business that deals with long-term revenue contracts, understanding now the consequences of some of those contracts you're entering into, and making sure you have considered and assessed what some of the implications will be, because ultimately you're likely to get caught up under this new guidance, so you're not resulting in unintended consequences. And I think, Pete, you alluded earlier on to if you don't get the performance obligations in some of your revenue contracts set up properly, you could end up deferring revenue for an extended period, which obviously from a commercial perspective, so getting out and talking to the rest of the business, the operations folks, real estate in the case of leasing, I think helps to build the business case to Brian's point. So it's not just finance saying we need budget to do an accounting exercise, but there is a more commercial rationale for why companies need to be thinking about this.
So this is a great segue. So let's spend a little time on leasing, because we've got some interest here and expertise. So what other things can customers start doing around the leasing topic? What should they know? How should they prepare? I don't know, maybe Rich, you can take this one.
Sure, Pete. I guess what we're looking at is like everyone was saying, and Miles and Eric and all that. But you have to take a holistic view to everything here, and not look at these piecemeal projects, but look at them in total as well. What I've been seeing is also looking at it from a measured approach perspective. You have to really know what you have and what you're starting with to know where you're going to go. And you kind of have when I say measured approach, it's like looking at it two ways. Looking at it from how large and how complex could these impacts be to your business, your operations, and your IT environment, and trying to, if you can understand those questions and how at least at a high level that could impact your company, you can say, well, if it's large and complex, great. What does that mean? It means I'm going to have a longer period to make sure I can stabilize this new accounting, not just the brand new accounting, but even from a multi-GAAP accounting perspective, you're going to have to show comparative information for a couple of years. So that adds additional complexity to it, right? So the larger and complex you think the issues are for your company, you're going to need some more runway and some more time to build in the processes that are going to need to be put in place, the controls that are going to need to be put in place, and update the systems around, where it depends on how far you may have to embed that change into your system. Right? You may have to go all the way down to a subledger level if it's that complex, versus if it was more simpler and more smaller, you may be able to track it at a higher level with more of a GL or consolidation system, and potentially supporting it with some Excel. But there will be a lot of data attributes and more granularity that's going to come with a lot of this information. So the systems will have to be prepared to be able to track that data, so you can do the analysis and reporting that's going to be required for it. Just one more element of that measured approach is really just trying to find out where you are on your capabilities. So, do you have new GL implemented already? Are you ready to go with parallel ledgers? Do you have a consolidation system in place? Does it need to be upgraded? Things like that are also thoughts that may come to mind as part of other projects you may have going on currently that could also get assigned and interlinked with these types of projects.
Okay, makes sense. I mean, what are the major risks then companies might face in this area of leasing? And I know, Miles, you had mentioned a little bit that there seems to be some ripple effect or interaction with revenue recognition, right, in terms of the leasing. But what are the major risks that companies would face with this, change in the new regulations, and maybe even in terms of how they adopt or the timing of the adoption?
Sure, Pete. I mean, I think, obviously this has fairly major implications to companies' balance sheet and income statement. So I think not understanding the magnitude of some of those changes and starting to manage the external communication of them is clearly a risk. I think one of the things that we see as clients are starting to think about this and starting to do some due diligence on their existing processes around gathering the footnote disclosure for existing lease accounting under US GAAP is perhaps the process isn't as robust as they might have expected. So actually starting the process now to gather the data, understand the complete portfolio of leases that exist across the organization, I think will help to mitigate some of that risk on transition.
Right, and Pete, I agree with Miles. I think that's a key area that many are focused on, and it really opens an opportunity up. And I always like to try to think, like, is there a business improvement opportunity when we deal with accounting changes? And the one here, I think, is people have misdirected or missed the opportunity to manage their capital spend in the form of what has been operating leases. That there have been capital decisions made that have gone under the traditional radar screen of the finance and the capital budgeting process at many companies, and the fact that their month-to-month or year-to-year rentals haven't been looked the same of what's the implicit cost embedded in those rentals, and are we really ready to be obligated to take on that commitment, and would we look at it differently if we were thinking at it from a capital budgeting perspective? And I think people will find they're spending a lot of money to get equipment that isn't that sophisticated, and when they look at it, say, why would we finance copiers at that rate if we didn't really need to? And that's an opportunity, right?
It's a great point, Ryan. I wholeheartedly agree with that one, and I think obviously the knock-on consequence is looking at the processes around that capital appraisal and approval, getting Treasury involved and actually making some of those decisions more strategically around how you leverage your finance structure and your capital agenda.
Yeah, and I think another one we're seeing is those decisions have been so disaggregated and decentralized that they're missing purchasing power. Right? If you look at when companies don't know where their leases are, they certainly don't know how they can go and bargain for a global rate as opposed to a local rate on buying decisions. So I think there's some really key economic opportunities here that make adopting this proposal a lot more attractive.
This is Eric, and certainly agree with the economic potential business advantages there. And one thing that I kind of come back to when I think about kind of the tremendous data impact and process impact is that if you think about how companies today manage their leases and their footnote support, many times it's very manual or Excel-based. Even if there are capital leases, many times they are in spreadsheets, spread throughout subsidiaries, either throughout the U.S. or throughout the world. So as you move to a realm where there's a lot more data needs to be controlled and maintained, and it's driving balance sheet, income statement amounts, there's likely to be new processes and new controls around that. So thinking about the impact of the overall internal control environment, whether that is going from a manual to an automated system through system solutions, or putting a new round of kind of processes around the collection and the maintenance of data. It's just something to consider as well. It's just the impact overall kind of SOX and the internal control environment as there may be some significant changes coming through this.
Yeah. A great point, Eric, and I think as well as the kind of the debits and credits and the impact on the balance sheet and income statement, I think the opportunity to aggregate all of the disclosure information within a systems environment is also important. And I think sometimes with a lot of the debate about the core principles of these projects that we've been talking about, some of the additional disclosure requirement gets lost, and a lot of them have much more onerous disclosure requirements around them as well. So anything to, as you're going through opening up the system to embed more of this into the systems environment, I think would be helpful. For example, in the other area we see with lease accounting is also getting tax involved, because a lot of additional tax information that perhaps isn't being currently gathered in a systems environment that the tax department will need as part of their computations. So again, just thinking holistically about it, trying to get a holistic approach that embeds all of this into the systems, into a better controlled environment, I think is an opportunity.
Yeah, I agree, Miles. I totally agree with where you guys are going, because you're going to have to, the level of granularity that you're going to have to maintain now is much more, from a data perspective, is going to be much more stronger and much more complex. So you're going to have to be moving that from the details of various subledgers, whether fixed assets or lease obligation type subledgers and things like that, moving them up through your GL, moving them into your reporting environment, your data warehouses, so you can get all the different types of reporting and slicing dicing that you wanted. Of course, you have to consolidate it. And then you go to the last mile of finance, as you just said, making sure you have all those disclosures. So you can see how an impact like this can ripple all the way up your technology stack, looking at all the different types of applications involved. Right, so there can be lots of different changes, and then that's just talking about leasing, and then you're going to have another one for potentially for revenue recognition as well if it's applicable for you.
Okay, sounds good. Now with that comment, I think we are at our Q&A time slot. So I want to turn it back to John. Thanks to panelists for their great in-depth discussion. We'll have a polling question, and then we'll actually get to a few more Q&A here. So John?
You got it. Thank you very much there, Pete. And I'm going to, actually I've just launched the second polling question, and we'll get back to the panelists with questions coming from the audience here in just a moment. So we'll leave this up for another 30 seconds or so. Once again, if you're here for CPE credit, we need you to take this. If you're not, we'd still love you to take this. Just take one moment to take a peek at the question. And at this point, also, if you have questions for the panelists, we've got a number stacked up here, but feel free to ask. And even if we don't get to answer your question here and now in the time we have remaining, we'll try to follow up with you afterwards and see if we can get you an answer. And with that, we'll go ahead and close this second poll. Actually, I think one thing that we might do for starters here is share the polling questions so folks can see where everyone else stands on these issues, and I'd love to get some comments from the folks on the panel as well. So the first polling question: have you begun to consider the potential impacts of the convergence standards on your business? Roughly 50% yes, and roughly 40% no. Eric, what do you think about that distribution, and is that more or less what you're seeing when you're talking to clients out and about?
John, it doesn't look unreasonable. I think a lot of it is driven by the mix of the types of industries and companies represented on the call. Because if you think about the nature of the converging standards, revenue, leases, financial instruments, they may impact industries differently, and especially whether a company is, say, has just a U.S. domestic footprint versus a global footprint, certainly has an impact there. So, the response does not surprise me. I think a lot of that is kind of dependent upon the breadth and depth of the types of companies and industries that are on this call. Something like leases, I think, is somewhat industry agnostic, in that no matter what industry you're in, you're going to have leases, whether it's real estate, equipment, photocopiers, whatever it is, you're going to have leases. You think about something like revenue recognition. A lot of the new revenue model is based on understanding the performance obligations, or to use a past term, the multiple elements of a revenue contract. So if you're in an industry where kind of your revenues are pretty straightforward, say manufacturing, you're just selling widgets, might be less of an impact than somebody maybe in a technology or a telecommunications company that has a lot of, maybe think about telephone handsets, sold with a service contract. You've got some embedded kind of hardware and service, multiple elements there. And I know telecom companies had some pretty pointed feedback, both the FASB and the Iasb, about the kind of the level of effort it would take to follow the new standard, not only from the pure accounting standpoint, but also the additional disclosures required for the individual performance obligations. So a lot of it is kind of drawn on the types of companies.
Gotcha. Right. Let's go ahead and take a quick look at the first poll that we had put out there as well. And this one was, who are your companies responsible for tracking IFRS/convergence issues? CFO, controller, technical accounting, external, and no one. Miles, I was interested to see this result where CFOs are at the top and external, which I think in most cases probably means auditors, are almost at the bottom in terms of those who are tracking this. Does that result surprise you, or does this kind of fall in line with what you said?
No, I think it's probably broadly consistent. I suspect the actual delivery of some of this will probably get pushed down to the controller and technical accounting specialists. But I'm sure we certainly have a lot of conversations with CFOs around some of the more strategic issues. I think to the discussion earlier on around the capital agenda. What are some of the consequences on commercial relationships with customers? How should relationships with banks and lenders and other providers of finance be reconsidered in the context of these changes? I think obviously gets to the CFO's agenda.
Right. Okay, thanks for that. And with that quick look at the polling questions, we'll go ahead and hop into the attendee questions for our panelists. And first up for Brian initially, and we'll ask if other panelists want to weigh in on this, but are we seeing that there will be differences in the application of convergence changes, either in the substance and or timing between privately held companies and public companies?
It's interesting. They have part of the debate around whether the U.S. should go with IFRS or not raised a lot of focus on the different needs of private versus public companies, or even within public, of small, relatively domestic-only companies and large multinational global companies. And part of that, there was the formation of a private company accounting standards committee of the FASB, and they haven't really created an agenda yet, but there was some concern about allowing optional adoption of IFRS in the public company world, of creating a two-tiered GAAP standard within public companies in the U.S. And I think the handwriting's on the wall that there's a clear recognition that some of the burden of accounting standards in the U.S. has gotten so difficult for smaller companies and smaller issuers that there's likely to be more and more two-tiered GAAP over time, and the mechanism has been created to allow that to happen. I'd say in the last 20 years or 30 years, there's been a real drive to eliminate two-tiered GAAP and try to have more single public company GAAP apply to everybody, but I think the tide is shifting. I don't know what Miles or Rich or Eric think, but
anyone else want to weigh in on that, as the pendulum looks like the pendulum might be poised to swing in the other direction?
I think there's certainly movement to try to simplifying the accounting for private companies from an IFRS standpoint, and shifting more on, say, the convergence type activities right now around leases and revenue. And many times there may be kind of a one-year deferral on effective dates for private companies around those new standards, but we'll be waiting to see the final standards for kind of confirmation on that.
Right. Okay, moving on. Rich, can technology help with the adoption of these new standards, and what are companies looking at from their tech providers to help them with these issues?
Great question. I think definitely technology is going to be the enabler of good process change and good process improvement. And then we talked about the data requirements and everything like that. But I think from a vendor perspective, with all the ERPs out there and other providers, everybody is also caught in the process of waiting for what the final standards are. going to be, and so we can't make all the changes to the systems until these things are completed and you can finalize them, right? So it's a cart before the horse kind of thing.
Right.
So the vendors are caught in a similar situation in providing solutions to their clients. But I think you have to take some steps. We kind of mentioned it before, so getting started in doing some data collection, getting started in doing identification and organizing your data, and then potentially storing the data in some kind of a storage location, a staging location, where you can view all the data elements and getting it all prepared for the eventual data load into your ultimate repository, the SAP ERP or some other component to get it to the functionality that'll be being used by that technology. So you can put some steps in place to start definitely the data collection and organizing that data and standardizing it. Those are two monumental tasks for some companies because of what I mentioned before as well, because it's global, it's everywhere, it's in somebody's desk drawer. That's a lot of work to get that all organized and staged before you even get that loaded into an ERP solution.
Right. And actually, let's ask Tom Anderson to chime in here. Tom, what are your clients asking you, and maybe more broadly SAP, for in terms of support? Obviously, a lot of changes coming down the way, and people are going to want to automate this to the extent possible. What are you seeing out there?
Right. So the first thing is I would not underestimate the amount of work involved with gathering this information. And what our customers are asking us is, well, we know it's going to take time to gather this, so can you help us put this information in SAP now? Can you give us some tools that we can capture the information to standardize it so it can be used in analysis and reporting in the near future prior to the adoption, right? So we can do some kind of pro forma analysis, and then when the regulations are adopted, we can simply convert that data and move on to an operating system. That's what they're asking us for, and we're in the process of gathering that information now and getting our customers ready to meet some of these requirements.
Right. Okay. Thank you. Eric, with real convergence in every area somewhat out in the distance, and in some of these areas way out in the distance, are you advising companies just to kind of hang tight, or how deep into this do you think they should be getting at this point in terms of preparation?
Well, many times in the marketplace, what I've found is that over the last couple of years, IFRS has basically become a four-letter word in terms of, companies are tired of hearing about it because, the SEC is dutifully going through their work plan to decide if it makes sense for the U.S. reporting markets to go to IFRS. And so, because that process is dragged on, there's much less of an appetite for companies right now really to focus on that, which is understandable because in terms of allocating resources and focusing on what's important to a company, since all companies have a long list of strategic priorities, it doesn't necessarily make a lot of time to focus on something that is still a moving target, which is why, a lot of the conversations and focus right now are on which standards are actually changing in the near future. So a lot of that focus is on the converging standards, leases and revenue recognition. And if you think back, again, to that kind of polling question that asked, have people really thought about convergence yet, and was kind of split between yes and no, some of those no answers could be, we want to wait until a final standard is issued so that we don't get too far ahead of the curve. And depending on the breadth and depth and complexity of an organization, that may be the right approach. For a global organization with subsidiaries all over the world, with leases all over the place, doing a little bit of work on the front end to kind of understand the breadth and depth of leases, starting that sooner rather than later is probably a good thing.
Right.
Now, compare that to a U.S. manufacturing company that has a small footprint, the ramp-up time will be a little bit shorter. So depending on the size of the company, maybe driving how kind of involved they are in terms of committing time and resources at this stage in the game.
Gotcha.
John, it's Miles. If I could just add quickly, I think wait and see is a very valid strategy here. But I think if your executives, your audit committee come asking the question, what have we done? You need to demonstrate you've done enough to validate that strategy is appropriate. So what you don't want to be doing is getting called out. So that would just be my recommendation.
Great.
Yes.
And time for one last very quick question here. I'm going to address this to Miles. So with the continuing globalization of companies, even down to the SMB size in the U.S., if, say, China, Japan, some other major industrialized nations decide not to adopt IFRS provisions and say so publicly and loudly, would that throw a hand grenade under this thing, possibly?
Under IFRS or Convergence? I mean, I think
under Convergence.
Yeah, I mean, I think both the Iasb and the FASB are well progressed, with these projects. So, they're dealing with issues that both boards recognise there were some challenges with the existing guidance under both US GAAP and IFRS. I think they're both very committed to seeing these projects through to the end, and I think we will see them completed. I think what we've seen over the last few weeks, with both revenue and leases, is we're getting much closer to the end game. I think that the principles are agreed. Clearly, some of the the nuts and bolts about how they get adopted and the timing for adoption needs to be settled down. But I think these major projects you will get seen done in the near term.
Great. Okay, well, thank you very much. We're going to wrap up really quickly here. First off, great thanks to the panel. Wonderful job, folks, including Pete, Tom, Miles, Brian, Eric, and Rich. Just a wealth of knowledge on the line today, and I really appreciate your time and insight. Certainly, if anyone has any questions at all about today's goings-on, we have the survey that you'll be prompted to take as soon as you step off of the webinar, and there's space there to ask questions, and we'll do our best to address them. We'll also work with the panelists to see if we can get answers to some of the many questions that I'm afraid we didn't get to today, and we'll probably publish those out on Performative and let folks have at them there in amongst the broader audience, but we'll also bring subject matter experts to bear on that. If you have any questions about CPE credit, you can see Tanya Walsh's name and email address right there, and she'll be more than happy to help you out. Of course, we'd love to thank our sponsors, SAP, not only for providing content and expertise today, but also for allowing us to make this event free, like everything we do at Performative. And finally, we'd like to thank everyone who attended today. We understand how valuable your time is, and we greatly appreciate you giving us an hour this morning. And with that, I will go ahead and close down the webinar. We hope to see everyone here soon, either online at performative.com or at another Performative event. Thanks, and take care, everyone.